Hi everyone, good morning, good afternoon, good evening, depending where you are. This is Emily, and I am a digital transformation consultant at Hyprbots. I'm very pleased to have Bimal on the call with us. Bimal is an experienced senior finance professional in the pharmaceutical industry, having served as a CFO as well. And today we'd be talking about ROI on AI led automation initiatives in finance. But before we get into the nitty gritty, Bimal, would you want to tell us a little more about yourself?
Sure, Emily, thanks. And thank you for the opportunity to join you to discuss this very interesting topic. So my background is that I have served in senior financial roles in several companies, almost entirely in the life sciences industry, or otherwise known as the biotech pharmaceutical industry, for well over a decade. That's across firms of various sizes. This includes roles as a CFO of a private company and VP of finance at a publicly traded company.
Got it. Thank you so much, Bimal, for your introduction. So, Bimal, what I've done is I have divided today's session into three sub portions, right? So, understanding ROI methods would be the first, followed by AI adoption in finance, and then finally, challenges and recommendation. So, diving into the first topic, which is understanding ROI methods, as a CFO, Bimal, and a senior finance executive, what would you have evaluated? You would have actually evaluated numerous projects of business teams from an ROI perspective, right? So, can you share some of the ROI methods or frameworks that you have used?
Sure. So first of all, ROI has a fairly precise definition and meaning, which is exactly return on investment. And that return on investment can be measured typically as an internal rate of return on dollars invested. This rate of return can be calculated on an annual basis or a total return across multiple years. Sometimes it's expressed as a percentage, or maybe expressed as a multiple of dollars invested, such as a 2x or a 3x return. Sometimes you'll also see it measured as a payback period, meaning how much time in weeks, months, or years does it take to recover the amount of the dollars that were invested. Some companies may have explicitly established requirements for ROI for projects in order for them to be undertaken.
Got it. Got it. So when we talk about returns, Bimal, it's both quantitative as well as qualitative. So in a lot of projects, the returns would be quantitative. So can you give us examples of ROI methods and their efficacies for such projects?
This question is, I don't want to sound repetitive, but it'll be a little bit repetitive to the previous answer. With regard to efficacies, though, of the ROI methods, which we haven't discussed yet, if you're asking how often do these ROI methods actually result in projects being undertaken that then actually achieve the targeted or expected ROIs, this varies considerably across companies, depending on how robust and realistic the initial evaluation of ROI has been. A robust ROI evaluation should consider many factors, including, but not limited to, the cost of the technology or project being implemented, the upfront and ongoing implementation, maintenance costs, including in terms of training and lost time on other activities, the potential later cost savings on headcount, for example, that is either reduced or maybe doesn't need to be hired in the future, or possible improvements in worker retention and morale or job satisfaction.
Got it. Understood. And when we traverse to the other end of the spectrum, Bimal, in a lot of other projects, the returns are qualitative. So it's quite tricky to measure returns there. Can you give examples of ROI methods in this scenario?
The qualitative returns are items such as improved and faster information flow, improved visibility into business, enhanced decision making, more confident decision making, etc. These are quite difficult to measure. So I don't see companies try too hard to actually capture these into quantitative types of ROI calculations. I think they simply try to keep them as a list of non-quantitative, qualitative benefits, and they consider those as they think about projects.
So let me actually, come to AI and its adoption in finance functions. In which processes do you see a higher possibility of AI adoption?
Certainly for invoice processing and overall management of accounts payables, I think that there is a higher possibility of AI adoption, likely also for accounts receivable collections and overall management of the accounts receivable. In both of those areas, there are a number of fairly basic tasks involved in managing the AP and AR, but these tasks often require multiple headcount and meaningful attention to detail in order to get them right. I believe these kinds of activities, these kinds of tasks may be the ones that AI is most able to improve.
Got it. Understood. And if you have to decide, Bimal, which part of the finance function you should take first for AI adoption, how would you decide?
I would focus on the areas such as AP and AR that are relatively, as I've said, low-hanging opportunities because the tasks are not too complex, but they are cumbersome and they do require attention. It would be best to illustrate the benefits of AI adoption in areas such as these initially, rather than more complicated areas such as financial planning and analysis, investor relations. Those other areas may ultimately find some benefit from AI also, but it may be later as these areas seem to require more human interaction, more judgment, etc., that AI may, at least in its initial stages, not be able to provide that much assistance on.
Understood. Also, Bimal, you said one of the methods is ROI and the process is invoice to pay. Can you elaborate what quantitative gains you see in AI-led automation for invoice to pay?
You would potentially need fewer people in accounts payable. So there could be a clear cost savings related to that, or you may not need to add additional people in AP or as many additional people in AP as your company grows. There might also be improvements in payments, such as being able to more readily achieve prompt pay discounts or avoid late payment penalties because you're better able to track and process the invoices on a timely basis.
Got it. Got it. And Bimal, can you also elaborate on the qualitative gains that you see for the same?
The qualitative gains are possibly in terms of higher job satisfaction for certain professionals who now don't need to manually do certain activities, and maybe less distraction for more senior management that may be able to spend less time on oversight of some of these activities. There could be higher employee retention and higher productivity of personnel overall. Although one might be able to measure these benefits, I would consider them qualitative since it will be likely very difficult to measure them and tie them back directly to the adoption of an AI technology solution.
Got it. Got it. So just out of curiosity, Bimal, how do you actually measure ROI on quantitative and qualitative gains?
On the quantitative, you'd measure the items that were mentioned previously around headcount savings, for example, and then compare this to the dollars invested into the actual AI solution that you have acquired and implemented into your company. On the qualitative side, I would not try to measure these. I think that is false precision and is probably not necessary. It's good to be aware of these, if you will, as bullet points in your mind, but I don't believe every gain, especially the qualitative ones, have to be measured precisely or that they even can be.
Got it. Got it. So, Bimal, delving into specific areas of AI adoption and calculating ROI, you said one of the key metrics should be cost per invoice processed. So, how could one measure it, including all the direct and indirect costs?
First, I'm not sure if cost per invoice process is necessarily the key metric. I think it is a metric. It is not one that I have personally measured in the companies I've worked at, but certainly it's possible that very large companies might do that, as they might be more prone to measuring all activities in a more precise fashion. Theoretically, it's possible to measure the direct costs, which are primarily the human labor costs, including the wages, salary, the benefits, the cost of the technology that people are using, the space they utilize in an office, etc. Then one could make an estimate of the time that people, as a part of their workday, spend on invoice processing, because it may not be 100% of their workday, and then calculate a cost of invoice processing overall, and then divide this number by the number of invoices that are processed. However, I think a more more typically, we simply think of the cost of AP at an overall employee headcount level and overall cost level of that area of activity. And we don't necessarily try to drive the calculation down to the per invoice processed level. With regard to indirect costs, I think we'd had to think about which ones are actually worth capturing and can be captured in an accurate manner.
Got it. Got it. Bimal, you also said that, there are cash flow optimization possibilities through AI-led recommendations of early discounts, right? Can you please share the math behind ROI on early discounts?
The math behind early discounts is fairly simple, and essentially it makes sense to do early discounts as long as first it overall does not put your company's cash position at risk. And secondly, when the cost of capital is lower than the value of the discount. So with regard to this second point, if, for example, your cost of capital is 15% per year, and a company is offering a discount of 1.5% for you to pay 30 days earlier than you otherwise would, then it might make sense to pay it 30 days earlier, since on a monthly basis, your cost of capital is 1.25%. In other words, 15% divided by 12 months per year. If, on the other hand, the discount for paying 30 days earlier is, let's say, 1%, then it may not make sense to make this payment earlier. Of course, there is another way to look at it, which is to compare the early discount rate, the early payment discount rate, not to the cost of the capital, but to the interest rate you're getting for your cash in the bank, which is likely a much lower rate than your cost of capital. Comparing the early discount rate to the cost of capital likely makes more sense for a company that is still cash flow negative and thus has to be obtaining capital from investors. Comparing the early discount rate to the bank interest rate probably makes more sense to a company that is sitting on significant cash and does not have obviously higher yielding projects in which to invest that cash.
Got it. Got it. Another thing I wanted to discuss, Bimal, was accrual automation. So you mentioned that accrual automation saves a lot of effort and time. How could compute those savings and the associated ROI there?
The ROI is still calculated in the same way. It will still be mostly savings in terms of headcount. In this case, it would be accounting staff headcount rather than accounts payable headcount staff. Accounting staff headcount is actually generally more expensive per person than the accounts payable headcount is per person. But the fundamental calculation would be very similar.
Got it. Got it. And to wrap up this sub portion of our discussion, Bimal, you mentioned tasks like credits and refunds are manual today. So, what kind of effort savings do you see there, and how do you exactly measure it?
Right now, at least in my experience, much of this is fairly manual in general, not just for credits and refunds, but across the accounts payable, invoice handling and processing activities. AI might speed up matching credits to new invoices, for example, so that you can more clearly and immediately see where there is an opportunity to offset an invoice because of a existing credit that you have. To be clear, credits and refunds are not so common an issue in every industry. So the value of this will vary quite a bit by the industry and how often credits and refunds are actually a part of the processing activity that an AP staff has to take under consideration and handle.
So, we all know it takes a lot of effort to manually communicate, as in follow up internally for approvals and with vendors on issues in general. How do you see that getting addressed by AI? And is there a way to quantify that?
The quantification would be, as we discussed, in terms of headcount savings and possibly in terms of early payment discounts that you're able to achieve and late payment penalties that you're able to avoid. I think that would be the set of numbers that you would bring into the calculation.
Yeah, understood. We also know that reporting and analytics have become technical in nature, and you need to ask a few accounting or IT people to give you the kind of information that you're actually looking for. Do you see some gains there as well?
Certainly, it's true that for regular financial reporting, you will often need to go to the accounting team to get that information. And I'm talking about items such as financial statements, income statement, cash flow, balance sheet, et cetera. To the extent that certain activities such as accruals are sped up and are made more accurate, all with less effort than was previously used due to the benefits of AI, this could
Mhm.
help the account complete its work more efficiently. I do not know that that will necessarily dramatically affect the headcount of the accounting teams necessarily, but it may lessen the burden on them somewhat. This will vary by company, of course. In a larger company that maybe has accounting team members specifically assigned to a task such as accruals, it's possible there could actually be headcount savings. For smaller companies, there may not be someone whose full-time job is accruals, so it may not be specific headcount savings, but just less burden on the team.
Got it. Got it. Vimal, there are also intangible gains like improved satisfaction of vendors and finance staff in general. Is there any way one can build ROI metrics to measure that?
There are likely intangible gains. I think they're very difficult to quantify. I would largely leave these as qualitative rather than quantitative and simply keep a list of those qualitative benefits. I think quantifying them would feel quite forced and seem somewhat artificial in terms of trying to specifically say that AI enhanced solutions are somehow directly and completely responsible for improved satisfaction of vendors or finance staff, et cetera.
Agreed, agreed. And any suggestion, Bimal, that you will give to CFOs and controllers on how to baseline or measure and publish ROI on automation initiatives?
I would focus on the ROI on genuinely quantifiable, measurable benefits and capture those in that manner. But with regard to the qualitative benefits, I would capture those in is as they are as qualitative benefits without trying to force measurement on these. I think that if you try to force measurement on what are really qualitative benefits, I think it may actually see that you're searching too hard to justify the ROI, and people will more likely be able to poke holes in the ROI calculations of qualitative benefits than genuinely quantifiable ones.
Got it. Okay, Bimal, so we talked about gains and ROI. There are also risks involved in AI implementations. So, how do you quantify that?
Again, probably difficult to quantify, but I agree there could be some risks, likely in the form of potentially damaged vendor or customer relationships if the AI implementation is not executed smoothly. The other risk in AI implementation might be if current AP or accounting staff come to feel threatened regarding their own positions because of AI implementations and where that might ultimately lead in terms of headcount. Both of these risks, I believe, can be mitigated and managed to some degree, but will require effort to do so.
Got it. So, if there is, Bimal, how to recalculate risk adjusted returns is the final call on the project go ahead? What should it be based on?
I would not try to over quantify the ROI. In
Mhm.
general, it's better not to try to have false precision. And I think trying to create a risk adjusted ROI is even more prone to false precision, since some of these other factors are even harder to quantify than the more basic ones, such as headcount savings. I think it's fine to focus on a basic ROI calculation that is not risk adjusted and combine it with a consideration of potential risks. Business people are capable of making assessments that combine quantitative rigor with qualitative considerations, including of risk. They do that all the time for
Mhm.
many kinds. For many organizations, I believe the decision on whether to adopt AI will not be entirely or primarily about a precise ROI, but rather about the type of organization they want to be. Do they want to be a cutting edge company that embraces change and the newest ways of doing things? or do they want to stick with older processes and approaches? I believe this will be the case, particularly if the cost of the AI solution and its implementation are not too high relative to other costs they routinely accept in their business. Over time, if the AI costs become meaningful or significant relative to their overall expenses, then it's possible they will try to better understand the ROI. And they will likely also then have actual data on factors such as the headcount savings, so they can do a more accurate ROI calculation. This may be a factor ultimately in their continuation, renewal, and upgrading of an AI solution, but it may not necessarily be the driver of, in the first place, implementing and trying such a solution.
Got it. Got it. So to wrap this section up, Bimal, just one last question. Who should own ROI metrics in a company for AI solutions adoption and finance?
I believe probably finance itself. The only other possibility could be the IT department, but ROI ultimately is a financial calculation, so I believe it should stay with finance. And in general, most ROI-oriented decisions, whether it's around implementing technology, undertaking some other type of investment, is ultimately something that's calculated by a finance department. So I don't see why it should be any different in the instance where it's an AI or technology solution that happens to be used in finance itself.
Got it. Got it. Thank you so much, Bimal, for being here today and walking us through, the ROI computation on AI-led automation initiatives, especially in the finance sector. It was really great having you. Thank you so much.
Thank you so much. It was lovely to have a conversation with you, Emily. Thank you.